Yesterday, something happened in the silver market that statistically should not have happened. A niche silver ETF traded more volume than the S&P 500, the largest and most liquid equity index in the world. That is not normal, and when markets behave abnormally, it usually signals that something larger is developing beneath the surface. The S&P 500 represents more than $45 trillion in market capitalization. It is where pension funds, retirement accounts, and global institutions allocate capital. The investable silver market, by comparison, is tiny, barely over $100 billion. Yet, in a single trading session, silver volume rivaled and even surpassed the S&P 500. That tells us this was not casual retail buying. It reflects aggressive positioning by hedge funds, high-frequency trading desks, and authorized participants moving large amounts of capital at speed. SLV does not function like buying a coin and storing it in a safe. Only authorized participants, typically large banks, can create or redeem ETF shares. When demand surges, they can issue new shares, hedge exposure with futures, or source physical metal. On paper, this system appears efficient and liquid. However, when turnover accelerates to extreme levels and the same ounce of silver is effectively traded many times over, that represents financial velocity far beyond physical reality. Markets built on leverage operate smoothly as long as confidence holds. When confidence is tested, stress appears quickly. We have seen similar dynamics before. In 2022, nickel prices on the London Metal Exchange surged dramatically. Short positions were trapped, and the exchange halted trading while cancelling transactions to prevent systemic damage. That event demonstrated how quickly leverage can destabilize markets when positioning becomes extreme. Today, silver exists within a similar structural tension. Western paper markets determine benchmark prices, while Eastern physical demand, particularly from China and India, continues to draw real metal from the system. If physical demand tightens while paper supply expands, a disconnect can form between price and availability. Such imbalances do not always resolve immediately, but over time, pressure builds. Layered onto this is the rapid expansion of artificial intelligence infrastructure. AI is not just software. It requires large-scale hardware deployment, data centers, advanced chips, and extensive power systems. Silver remains the most conductive metal available and plays a critical role in electronics, power components, and high-performance computing. As hundreds of billions of dollars flow into AI infrastructure, industrial silver demand increases. Mining supply, however, does not scale at the same pace. Developing new mines can take a decade or more. Software scales exponentially, mining does not. That structural mismatch becomes more significant over longer time horizons. Looking forward, several outcomes are possible. One scenario involves heightened volatility, including sharp corrections that remove speculative positioning. Precious metals have historically experienced dramatic moves in both directions. Another possibility is stable paper pricing while physical availability tightens, resulting in higher premiums and extended delivery times. Neither outcome necessarily implies crisis, but both warrant attention. Silver should not be treated as a speculative lottery ticket. It is better understood as a form of portfolio insurance. Insurance is not purchased with the expectation of disaster, but to provide protection if instability emerges. Any exposure should be sized responsibly. Excessive leverage and emotionally driven all-in decisions increase risk. Physical ownership requires consideration of storage and liquidity. ETFs require understanding of structure and counterparty exposure. Futures demand a clear grasp of leverage mechanics. When a relatively small asset suddenly trades with the intensity of the largest equity market in the world, it is rarely random. Capital reallocations at that scale often reflect institutional repositioning or emerging stress within financial plumbing. Whether this episode signals deeper structural tension between paper pricing mechanisms and real-world demand, or simply strategic repositioning, informed investors recognize that abnormal market behavior deserves attention. We are entering a period where artificial intelligence expansion, geopolitical friction, energy transition, and monetary policy shifts are converging. In such environments, hard assets can reprice quickly. The appropriate response is not panic, but discipline. focus on structure, risk management, and long-term positioning. In markets, survival and rational decision-making matter far more than short-term speculation.